As COVID-19 continues to exert pressure on the economy, investors need to maintain an adequately liquid portfolio for emergencies. Here are a few steps to ensure easy encashments of your investments. Ideally, a contingency fund equal to at least 6 months of expenses and equated monthly installments should be parked in bank fixed deposits and liquid funds. Take a look at your portfolio and identify which instruments are liquid and which ones aren't. Shares, equity and bond funds are liquid assets which can realize cash within 2 to 5 working days. But do not sell indiscriminately. If you do not have enough cash in your savings account or bank fixed deposits, only then go for your equity shares and mutual funds. Identify poor performers in your portfolio. Do not touch tax savings mutual funds as they come with a lock-in of 3 years. Stop your SIPs if you are suffering from a genuine cash crunch, but resolve that when matters improve and restart your SIP. Else, your financial goals may not be achieved. Investments in unit-linked insurance and traditional life insurance policies also score low on liquidity, but see if you can liquidate them and assess how much money you can get. Investment-linked insurance plans are best to be liquidated under these circumstances. Physical gold holdings and exchange-traded funds too can be sold to raise money. Gold prices have anyway risen. Meanwhile, Public Provident Fund and Employee Provident Fund offer conditional liquidity. Avoid touching these. These are meant for your retirement and are very important. Real estate investments cannot be realized quickly, but one should pursue it in case of an emergency. Bank deposits are an option. Check the penalty before breaking them. If you do not have liquid assets to monetize, you can also consider taking a loan against them. These loans are cheaper than personal loans. Banks and non-banking finance companies provide loans for up to 50% of the present value of equity shares. But if you have lost your job or faced an income cut, then dip into your emergency corpus as much as possible instead of a loan. In times of job loss or income cuts, loan must be avoided as far as possible. If you have a majority of the portfolio in less liquid investments, you may want to make a prudent choice of changing the composition over time rather than selling immediately. It is advisable to look at the big picture instead of looking at each of the investments in isolation. If you have assets, a calculated approach to liquidating them can help you sail through without much pain. Apart from liquidity, look at your asset allocation. Ensure to retain your asset allocation as far as possible. As the virus is raging, it is better to review your portfolio's liquidity periodically.